Hey, if you hold crypto and own rentals, or you plan to use crypto for your down payment or rent, well, 2025 has brought new rules that can blindside you at tax time. So here's what I'm doing in this video. I'm going to show you what has changed and what has rolled back and how you can stay audit proof while keeping your tax bill low. All right? Let's get started. Okay, so what has actually changed here in 2025? First, I'm going to go into that and talk about these changes that you need to be aware of, and then I'm going to show you how that applies to you as a real estate investor who is using crypto to, as I stated, either pay your rent, make purchases, or maybe you're even receiving it. So here's what happened. In 2025, what they did is they took centralized brokers such as Binance or Coinbase, and now they require them to file Form 1099 DA for all your 2025 trades. All right, so anything that you've done in 2025 with crypto is going to get reported to the IRS. Now, what are they reporting here? Well, they're reporting on your gross proceeds. All right, so basis reporting is not yet mandatory. That goes into effect in 2026. And so this can create a problem for you if you invest in crypto, you hold crypto and you've been selling it. You want to make sure that your basis is accurately transferred. And so what does that mean? Well, prior to 2025, the rules allowed taxpayers to use a pooled account method, not a wallet by wallet basis framework for digital assets. And so this is where we've changed now, where you need to be tracking each of your wallets, the cost basis of the assets you hold in those wallets. You just can't treat it as one common pool any longer. And so what that means is that if you're moving these assets between different wallets, you have to track that cost basis that moves from one wallet to the next wallet. So this puts more of a burden on us investors who are investing in digital assets. And so what does that look like? Well, that means each investment you make, you have to list your purchase price, all right? That has to be logged somewhere, okay? The type of transaction, of course, would go in. If you're buying or selling, that needs to be in there. And the type of crypto that you're investing in, the fiat value at that time, and all the transaction fees. So that's really important. You got to be doing this if you're investing, of course, and you hold crypto. Now, I was talking about a centralized broker there. Now, with the DeFi brokers, the expansion was repealed in 2025. And so, Congress kind of rolled back that rule and allowed you to treat many decentralized platforms, such as, say, Uniswap. They're brokers. However, they do not report on 1099. So you're not going to receive anything from them. So you're going to be responsible to do this on your own. So those are some really big rules that went into effect this year, and it will have an impact on your real estate investing, as I'm about to share with you, because knowing your cost basis is going to be really important when it comes to using crypto for real estate. So how do investors get hit when it comes to using crypto? Let me just show you an example here if you wanted to buy real estate and you wanted to pay for it with your crypto. So let's assume that, okay, I'm right here and I find this house and it's $350K to invest this house. Now, I'm going to put down $100,000. So I'm going to give the owner of that property $100K in Bitcoin. So I'm going to transfer that to them. Now, if I just transfer the $100,000 to them, I think, okay, great. They're going to carry the contract for the rest. So I just moved $100K. I'm clear, and I own this property. Well, see, the problem is that when you do that and you transfer that coin to the actual seller of the property, there are tax consequences to you. And that is, you're going to owe a capital gains tax on the difference between what you paid versus what it's worth when you transfer that to this seller of that property. So let's assume that my original cost basis in this coin that I'm transferring to them, it was, say, 60K. So what I have here is a $40,000 gain. The difference between the 60K here and the $100,000 that I'm paying as my down payment for this property. So I need to be prepared to account for this come tax time. So that property, where I put down the $100,000, really it's costing me a little more there because I need to pay tax on that 40K. Assume you're in a 20% effective rate. That means you need to come up with $8,000 additional just to cover your tax liability for transferring it. And so I hope what you understand here is that you're not actually selling this. You're just transferring the coin. You're paying for it with coin, but it is taxable to you. The difference between what the value is and what your cost basis is. Now, this is why it's so important you track your basis. So here's a strategy tip then for those of you who want to invest this way and use crypto to buy real estate. All All right, when you're trying to determine which wallet to pull from, what I would be doing is looking at those or that wallet that has the highest cost basis. Let's say I made some recent purchases and I got in and my cost basis here was 90K. Well, that's going to eliminate the 40K and it's only going to be a 10K in gain there. So tracking your cost basis is really important to you, for you when you plan to use your crypto in this type of transaction. Now, what if you're on the other side? Let's assume that I'm the landlord and I allow my tenants now to pay me in crypto. So this is you're the landlord right here, and here's your tenant over here, and the monthly rent on this property is $2K a month. So you accept $2,000 a month in crypto as rental income for that property. Now, in accepting that, what that means is that you essentially just got paid in dollars. So you take that value and you say, all right, this is $2,000, it's what I've received. Okay, so you need to report that as rental income on your Schedule E. Okay, now, what you also need to do though is track it and timestamp it, know when it came in. So why is this important to you? Okay, the reasons it's important to you as a landlord if you're accepting crypto, because when I receive that coin, if I don't turn around and convert it right into USD, if I don't that day move it in, hey, that is going to fluctuate in value. And so if it came in and I'm representing that my basis in it is $2,000, I need to track this. Because if later, if I use that crypto to make a purchase, like I just showed you, to buy another piece of property, and that crypto has now gone up to 4K, well, there's going to be a $2,000 gain for me at that point in time. Essentially what they're doing is they're saying, when you take that coin, that is income to you, okay, and that becomes your cost basis, and you're responsible to track that, and you have to report that each year for tax purposes. Okay, so that's the basics there if you want to rent, okay, if you're accepting crypto as rent, or if you're using it to purchase a property. Okay, now let's assume that you're investing and you're staking crypto and you're going to use those proceeds to actually cover the mortgage. Well, here's the deal. Staking is income to you. So if you have a piece of property, right, and you bought the property, you want to use those staking proceeds to cover your payments back to that homeowner, like I showed you in that first example here, actually not the homeowner, but the seller of the property. Well, when you're using your staking rewards, you have to understand that that is considered income and has to be tracked, and you have to pay taxes on it at the end of the year. All right, it doesn't matter whether or not you actually got out of your underlying crypto. Okay, the fact that you receive that is considered income to you. So if you're in that situation and you're staking, you're receiving that, then what you need to be doing is setting aside money so at the end of the year you have the dollars to cover your tax liability. This is actually a huge problem I've seen that has come up. People are not aware of this, and it blindsides them when it comes to paying their taxes. So if you're using those types of rewards to cover, say, your mortgage payment in this example, then that is going to be considered income, and you have to be aware of that. All right, so what do we need to be doing then? Listen, you got to make sure that you're tracking your basis. Get those wallets moved around in the right basis for you, so you know which ones have your highest cost basis. So if you're using that for 2025 or going forward in 2026, you have an estimation then of what your potential tax liability will be when you turn around and use that for real estate investing. So that's really important. The other thing that I would throw out there as well, and even though it probably doesn't apply right now in this market, is that loss harvesting is still available in 2025. That means if you have coins that are down, digital assets that have gone down, I don't know many that have, but if you do, you can get out of those positions and then rebuy them back if you feel that it's going to shoot back up again, and you can take that loss and use it to offset your gains. So don't be thinking that, hey, all is bad here. There are opportunities for you to minimize your tax liability when you're using crypto by using the tax code to benefit yourself. If you want to learn more about tax savings for your crypto investing, be sure to subscribe to my channel and catch my video that will be coming up in the next couple of weeks on what you can do to reduce taxes on your crypto gains. If you liked the video, be sure to hit the like button. If you know someone else who could benefit from this content, hey, send them a link. With that, I wish you the very best with your investing.